Alright, let's talk about taking money from your family. Sounds simple, right? Like, if dad gives you money, it's yours, no questions asked. And surely, no tax. Well, hold on just a minute. This is where things can get a little tricky, and honestly, it's led to big problems for some people. Imagine this: someone gets a good chunk of money from their father to buy property. They think, great, it's from dad, totally tax free. Years later, the father passes away, and another sibling says, hey, wait, that property was bought with our father's money. That's part of his estate, and I have a right to it under succession laws. The person who got the money, they ended up losing a big part of the property. Why did this happen? Because they didn't properly understand the rules, didn't get the right advice, and maybe didn't have the right paperwork. They just asked around, maybe checked Google, and thought it was all free and clear. You don't want that to happen to you, right? So, today, let's break down how you can take money or assets from your family safely without any tax trouble and without creating issues down the line. First things first, how did this all start? There used to be a separate gift tax way back in 1958, which was stopped for a while. But then it was brought back in 2004, not as a separate tax, but under the regular Income Tax Act. It falls under something called income from other sources. This was mainly done to stop people from misusing gifts for money laundering or avoiding taxes. Okay, now the main rule is that gifts are actually taxable in your hands as income. But there are very important exceptions. The biggest one is based on who is giving you the gift. Here's a quick point. If you receive gifts up to 50,000 rupees in total in a financial year, they're completely non-taxable. This is a total limit from all non-relatives. If the value goes even 1 rupee over 50,000, the entire amount can become taxable in your hands. But the great news is, if you receive gifts from certain specified persons, they're totally tax-free, no matter the amount. Let's take a moment here. Who are these specified people, these relatives, as the income tax law calls them? The list is quite clear. Your spouse, your brother and your sister, your spouse's brother and your spouse's sister, the brother or sister of either of your parents. This means your chacha, chachi, tau, father's side, and mama, mami, mosi, mosaji on your mother's side. Any lineal ascendant or descendant of yours. This means your parents, grandparents, great-grandparents going upwards, and your children, grandchildren, great-grandchildren going downwards. Any lineal ascendant or descendant of your spouse. So, your spouse's parents, grandparents, etc., and your spouse's children, grandchildren, etc., if any. And, very importantly, the spouse of any of these individuals mentioned above. So, your brother's wife, your sister's husband, your son's wife, your daughter's husband, your father-in-law's wife, your mother-in-law, your mama's wife, your mommy, and so on. You might have seen this happen in real life. Gifts from this specific list are tax-free for the person receiving them without any upper limit on the amount. This is something most people get right. Gifts from close family are usually not taxed, but they miss some critical details. What kind of gifts are we talking about? It's not just cash. Gifts can be in various forms: money, cash, checks, bank transfers, investments, shares, bonds, mutual funds, ETFs, fixed deposits, immovable property, land, buildings, certain movable property, things like jewelry, paintings, sculptures, archaeological collections, drawings, shares, securities. Here's a quick point. For non-cash gifts like property or jewelry, the fair market value or stamp duty value for property is considered. If you receive these from a non-relative without paying anything and their value is more than 50,000 rupees, the whole value might be taxed. If you pay less than the fair value or stamp duty value and the difference is more than 50,000, that difference can be taxed. Let's quickly recap. Gifts are taxable, but tax-free up to 50,000 from non-relatives. Gifts from specified relatives are always tax-free, no matter the amount. And this applies to money as well as certain assets like property, investments, and jewelry. Now, think about this. While you, the recipient, might not pay tax on a gift from a relative, there are crucial things to ensure everything is proper and doesn't cause problems later. The most important point is the source of money for the person giving the gift, the donor. Their money must be from a genuine, explainable source. The income tax department can always ask the donor where they got the money from. If the donor can't prove the source, that can create issues, potentially even for you as the recipient. You should absolutely avoid situations where cash from various unverified sources is pooled together and then gifted. Why does this happen? Because the government wants to prevent black money or unexplained funds being routed through gifts. Another critical point is how the money is transferred. Always, always, always use banking channels for larger amounts. Bank transfers, checks, electronic transfers, these create a clear record. Avoid cash gifts, especially for significant amounts. There's even a rule under income tax that restricts accepting loans or deposits of 20,000 rupees or more in cash. The penalty can be 100% of the amount received in violation. This limit also applies to repaying loans. While this specific limit is often discussed in the context of loans deposits, the principle of avoiding large cash transactions for gifts from relatives is equally important for proof and avoiding scrutiny. You might have seen this happen in real life. Families giving large cash sums. But for your safety, documented bank transfers are key. Here's a quick point. If a relative is giving you money to buy something like property or a car, ask them to transfer the money to your bank account first. Then, you make the payment to the seller from your account. Don't ask them to pay the seller directly. This keeps the trail clean, showing the gift came to you, and then you used your funds. What about documentation? While a simple note might seem enough for family, especially for significant gifts like large sums of money or property, getting a proper gift deed is highly recommended. This is a legal document on stamp paper, ideally registered, and signed by witnesses. It legally proves the transfer was a gift. It's your solid proof if questions arise later. Let's take a moment here. Especially when receiving substantial gifts from parents and you have siblings, getting a no objection certificate (NOC) from the other legal heirs can be a smart step to prevent future family disputes over inherited wealth. This is something most people get wrong. They think family gifts don't need formal paperwork. But a gift deed is crucial for legal and tax clarity. Now, how do you deal with this when filing your income tax return, your ITR? This can be a bit confusing. While some people believe you don't need to show tax-free gifts from relatives anywhere in the ITR, the safer and recommended approach, especially if you receive a notice, is to disclose the receipt of the tax-exempt gift in the Schedule EI Exempted Incomes section of your ITR form. This way, you are being transparent with the tax department. However, and this is important, any income you earn from that gifted money or asset is taxable and must be reported in your ITR under the appropriate head, like income from other sources or capital gains if you sell a gifted asset. For example, if you get a gift of money and put it in an FD, the interest earned is taxable. If you get gifted shares and sell them, the capital gains are taxable. Let's quickly recap. Gifts from specified relatives are tax-free, no limit. Gifts from non-relatives are taxable if over 50,000 rupees. Always ensure the donor source is clear. Use bank transfers, not cash. Get a gift deed for important gifts. Consider an NOC for large family gifts. While the gift itself might be exempt, report it in Schedule EI of your ITR to be safe, and always report any income generated from that gift. Now, a common question. What about gifts from your friends? Or maybe a girlfriend or boyfriend? As per the income tax definition of relative, friends, girlfriends, or boyfriends do not fall under the tax-exempt category. So, if you receive a gift from a friend, including via UPI or e-wallet, unless it's clearly a debt settlement, and the value exceeds 50,000 rupees in a financial year, the entire amount is taxable in your hands as income from other sources. Sounds familiar? Now you know what most people don't. Maybe gently educate your friends about the tax rules on gifts from non-relatives. What about loans? Taking a loan from friends or relatives is generally not taxable for the borrower. However, the restrictions on cash transactions, maximum 20,000 rupees, apply to loans and their repayments too. If your relative gives you a loan and charges interest, that interest income is taxable for them unless certain conditions are met, like a written agreement, interest rate at least market rate, and not in cash over 20,000 rupees. Be careful about giving money to relatives in a lower tax bracket to earn interest for you, as this could be seen as clubbing of income and tax evasion. There are also specific rules under FEMA for borrowing or lending involving NRIs, covering things like banking channels, loan tenure, interest rates, and reporting to the RBI. An exception exists for loans deposits if both parties earn only agricultural income and no other taxable income, where the 20,000 rupee cash limit might not apply. Regarding deductions, if you take a home loan from a relative, you can claim deduction on the interest paid under Section 24 up to the specified limits, currently 2 lakh rupees for self-occupied property. However, you cannot claim deduction on the principal repayment of such a loan under Section 80C. Alright, let's quickly summarize the key points. Who gives the gift matters most? Gifts from your spouse, parents, children, siblings, their spouses, and siblings of your parents and their spouses are completely tax-free for you, the recipient, no matter the amount. Gifts from others, Non-relatives tax-free only up to 50,000 rupees in total in a financial year. If the value exceeds this, the entire amount is taxable. Different assets are covered. Money, investments, property, and certain movable items like jewelry can be gifted. Documentation is crucial. Use bank transfers, not cash, especially for amounts over 20,000 rupees, loan deposit limit, good practice for gifts too. Get a proper gift deed on stamp paper, preferably registered with witnesses, especially for large gifts or property. Consider an NOC from other heirs for large family gifts. Donor source matters. The person giving you the gift must have a clear and genuine source for that money. ITR reporting. While the gift from a relative might be tax free, it is safest to disclose it in the Schedule EI exempted incomes section of your ITR. Any income generated from the gifted money or asset is taxable and must be reported. Loans are different from gifts. Receiving a loan is not taxable for the borrower, but interest on loans given is generally taxable for the lender, with some exceptions. Cash transaction limits also apply to loans. Understanding these points can save you from future tax troubles and family disputes. Don't rely on casual advice. Know the rules properly. If it's still confusing, listen to this part again. Share this with someone who needs to know. Trust me, almost everyone does. Knowing these simple rules can make a big difference. Now you know what most people don't.